Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validity Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital or Sunpoint Investments.
So Matt, I'm really excited today because we get to talk about something that I know pretty much zero about, which is, sometimes we're covering topics that I know a lot about, but this time I'm going to learn a lot along with everybody else. So I'm excited today. We're going to talk about private assets. And we had Larry Swedroe on Excess Returns recently for our Show Us Your Portfolio. And we talked a lot about, he invests a very large portion of his portfolio. I think it's north of 50% in these private assets. And he uses things like interval funds to do it. So we're going to work through all of that today. We're going to work through the different private assets you can invest in. We're going to work through how it works behind the scenes. We're going to try to get into all the details. So I think this is going to be a really interesting one. And we're lucky to have Lee Boudouris from Sunpoint with us today. He's going to help us because we are certainly not the experts in this topic. So Lee, thank you for joining us.
I'm glad to be here, Jack.
So where do you think the best place to start is, Matt? Maybe just at a high level, like why someone would even do this. We've got a lot of things in the public markets we can invest in. We have a lot of choices. Why would someone want to go beyond that? Why would someone want to invest in private assets?
So we run into this question professionally all the time. And that is people come to the conclusion that so they get over the initial phase of like what you can buy in a brokerage account, stocks, bonds, funds, ETFs, individual CUSIPs, real things. And at some point they realize active management is really hard. They go through their Vanguardians of the Galaxy phase where they just want to index and whatever else. And then they arrive at this point where they're like, wait, there's other stuff too. And they hear somebody like Larry Swedroe on your podcast talking about this. And they're like, wait, there are other ways to be active, but they require me to go away from public markets in some way. And that sounds really cool. That sounds really interesting, but there are so many details here. And at some point, Lee and I, we spend so much time just educating people about these things and looking at the opportunities. And I am not the expert. I learned pretty much everything I know from Lee. That's why we need to have him here. So Lee,
no pressure, right?
No pressure. Jack, you're the Vanguardian of the Galaxy, and I'll be, I don't know, pick a Marvel bad guy. I'll be him. Lee, let's start here. Just maybe define private assets and give us just an overview on like, how big is this space? How big is this fund space? Why is it growing way, way too fast right now? What's going on with privates?
Yeah. So at its most basic level, a private asset is anything that doesn't trade on Jack's Vanguardian platform. So anything that's not trade or able to be bought and sold every day, bought and sold. Some you can buy every day. We'll get to that, but you can't sell them every day. Why do it? Well, we'll talk through the three main categories, but most of what we'll talk through today applies to all three. Private equity is just a company that doesn't trade on a stock market. So Sunpoint is a private business. We're not owned by private equity. We're owned by the leaders of Sunpoint. That's an example of just most businesses in America are not publicly traded. It's a huge opportunity set. And over the long term, private equity has outperformed public equity. All right, everybody understands outperformance. And the long-term expectations about 3 percentage points. It comes up and down over time, moves a lot. It's supposed to be a long-term investment. But over the long term, that's the goal, is to beat public markets. Within real estate, well, if you own a house, you own private real estate. Everybody knows the S&P 500 for large cap U.S. stocks. There are publicly traded REITs that are stocks and trade like stocks. The Vanguard index has about 170 of them. So you're dealing with a very limited opportunity set. And those indexes are driven largely by the largest 2 or 3. You want to talk about concentration in the S&P 500, the REIT market's got that covered, and then some. And then the third one is private credit, which is in its highest level investing with generally smaller companies that banks used to cover, but post financial crisis either can't or don't want to anymore. So that's a growing opportunity set as well. They're all, or almost all, floating rate, which has been really great the last 2 years, and doesn't have the daily volatility that we've, especially in the last year and a half, that we've seen from public fixing. So there's lots of reasons to own these. We can kind of talk about everything that joins them all together.
As like an outsider, it seems to me like these things have grown a lot. Like I don't know a lot about it, but I see tons of stuff in the news. Like it seems like all these private different things you referenced are a lot bigger than they used to be. I mean, is that the truth behind the scenes?
Yes, in a word. Until the last several years, private investments were for institutional investors and large families. You had to be qualified purchaser, so $5 million in assets for individuals. You had to meet very high minimums. You had to pay capital calls, so you can just make one investment like we're used to and be done with it. You have to invest over time, which is a pain. You get your money back whenever the manager decides, earns enough to give it back to you or sell something. So that takes forever. That's a pain. You don't get 1099 tax treatment. They come as K1s. So it's just operationally very intensive to do this. Over the last, especially 5 years, that's changed because investment managers have realized, all right, we've pretty much got the institutional market tapped out. It started growing leaps and bounds, especially after David Swenson's books for the Yale Endowment kind of made the endowment model, which is alternative heavy, very popular. Most institutions are now doing something like this. So what's next? And that's people like us managing broad wealth clients, but these clients can't invest $5 million in something. I know of funds that have a $10 million minimum. That's not something we can handle. But when you start getting to newer vehicles, that the vehicle structures have been around forever, no one just ever used them. And now you're talking minimums from 0 to 25,000. Now you're broadening the opportunity set significantly and including so many more investors.
I think it's so important just to say, to put like the highlighter on this point you made. So private, just to demystify the word private, just means something that doesn't trade as easily as public.
Right.
Simple. Private does not trade as easily as public. So we have this whole other thing. And I love the examples you gave because it's like private equity just means a business that's not listed on the stock market. Jack, I'm sure Validia, you guys are like the Domino's pizza of private asset managers, right? Research.
I would say so. Yeah. It's comparable returns, right?
Comparable returns, comparable pizza crusts. So private equity, just think non-publicly trading company. Private real estate, you own a house. Congratulations, you're a private real estate investor. Private credit is, you give Joey a loan for lunch money, and congratulations, you're in the private credit business. So we demystify this word private to just mean non-public. But then what's happened, and we love to use this word, the democratization of investing. Like, oh, it's such a righteous divide thing. It's no. We tapped out the institutional and the giant asset markets. So now the productization of these vehicles is why it's coming downstream. However, within that, there are certain things that are really interesting to access. And there are some ways to do it that aren't disastrous. To be clear, a lot of bad ways to do this, but there are some really good ways to do this too. And that's why we want to focus on kind of the vehicle types and some of the language as people start to ask these questions, because they can ask these questions now for the first time ever.
Yeah.
Right.
Picking up on like the vehicle type, when I think about like private equity, I've always thought about like a fund that has a start date, people commit money to it, they draw down the money as they get investments, and it has like an end date and it's over. But that's in terms of the things that are coming down to financial advisors and to more average people. I don't think that's the way it works. So can you sort of talk about how these things actually work?
You're absolutely right, Jack. So the traditional private equity fund that institutions have been investing in for decades, you're right, has a period of years that they can make investments, another period of years to manage and grow those investments, and then a date by which they're supposed to have everything sold. It usually doesn't work like that because they can extend the fund because, hey, we can't sell something. Seen a lot of that in the last few years. But eventually the fund does end. With these newer funds that people like ourselves can access for our clients, I use the word evergreen because people know what that means. They don't have to end. If now someday if it's not working and they want to sell everything and shut the fund down, of course they can do that, but they don't have to. They have to offer some liquidity on a periodic basis, and we can talk through that. But they can run forever. They buy a private company, they grow it, they sell it 5 years later, they have cash, go buy something else. Wash, rinse, repeat.
So how does it, let's talk about like interval funds are one of the things you hear a lot about now.
Yeah.
Let's just talk a little bit about how the liquidity of these things works. So obviously if I invest in any of these vehicles, I can't just go tomorrow and say, you know what, I decided I didn't want to invest, like give me all my money back. Like
Yep.
I'm used to being able to do that with ETFs, with stocks. I can't do that here. So can you explain a little bit about how that works?
Yep. So an interval fund is a 40 Act structure. So it has a ticker. 5 letters, ends in X. We know what that means. So an interval fund, you can buy the vast majority of them every day through your custodian. Put in a ticker, blank, 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 X, buy $10,000. If they'll take it, they usually will. All right. An interval fund must offer at least 5% of its value every quarter for redemptions. Must. That's a key word because we'll differentiate that as we go along. They can choose to offer more. They don't have to. So for example, let's say Jack's interval fund, they have to set a schedule. All right, on the 15th of the third month of every quarter, we're going to offer 5% of the fund. And if you want out, put in your sell order through your custodian. The fund gets 3.5% of the fund in redemptions in a given quarter. Everybody gets paid out 100%, just like you're selling anything else that we're used to. If they get more than 5% in redemptions, now they have a decision to make. They can provide full liquidity. So they get 6%, they can choose to pay out 6%. Or you can get a pro rata. So you would get, if they only say, we've only got 5%, every investor who submits a redemption for $10,000 would get 5/6 of that. And then they can put in another redemption next quarter. And it hasn't happened too much in recent years. We saw quite a few of them in 2020 go over 5%. Sometimes a manager will launch a new fund, and some investors want to put some of their money from the first fund to the second fund, so you see spikes in redemptions that way. But the markets, even including 2022, which was pretty rough, we didn't see too many interval funds run over 5% in any given quarter, but it's still a risk. So investors have to know you are not guaranteed the ability to redeem all of your investment every quarter. You'll get something back, but you're not guaranteed to get everything.
I think this differentiation too, and again, to just take it back to this private versus public, private just means it's harder to sell. So
Right.
The expectation that you can sell goes out the window when you throw private on it. Do you want to just take us through, let's just stay on interval fund for a second, because I think this is interesting. Interval funds in private credit, yes, but why don't we see the proliferation, say, of interval funds in real estate or private equity?
So there are interval funds in real estate. There's not as many. Most of the evergreen real estate funds are in a different structure, and we'll get to that. There's I know of a handful, maybe a couple handfuls of private real estate interval funds. They're not as common, in my opinion, for one key reason. It's harder to sell a building than it is to sell a private loan. A private credit manager can sell a loan. The private credit market's much bigger. It's going to be easier today than it ever was. Are they going to like the price they get? That's a different question. If you're trying to sell, let's say you bought an office building 7 years ago and you don't want to take a price that's 30% less than what you bought it for, well, you'd rather hold it if you can.
You mean they don't just go on Facebook Marketplace and list these things? That's not the solution?
No, that's not how that works. That's why I highlighted the word must. Must offer 5% a quarter means one of two things. You have to hold a lot of cash, or you risk running into liquidity issues.
And if you hold a lot of cash, that dampens your returns, and that's a drag, right?
Right. So cash drag with these evergreen funds is something I pay a lot of attention to, because you need liquidity to run these things. It's just a pain sometimes. And if you're going to invest in a private asset, you're expecting higher returns. Well, you don't want to waste it all on cash. I mean, at least cash earns something today. If 2 years ago it earned 0.01%. In private equity, it's even harder. So that's why you don't see a lot of interval funds. There's a couple that have opted for the interval fund structure, and they do hold a lot of cash. That's their way around it.
Yeah, and I can see, as you're saying that, how it wouldn't work with private equity, because if you think about it, you go through a 2008 type period, I have to offer 5% every quarter. It could be a long period of time before I can sell these companies at any kind of reasonable price. I would have to either have a lot of cash, or I don't know exactly what I would do if I didn't have a lot of cash, but I could get myself into some trouble there where I'm stuck with these, I've got to sell these things at a fire sale price, because basically every quarter I continue to get the 5%.
Yeah, think about it. So the few interval funds that do exist in private equity tend to hold 10 to 15% cash. So that's 2 to 3 quarters worth. But let's say 2008 happens, Jack. Your private portfolio gets marked down eventually by a decent amount. That 10 to 15% in cash is now, see, it's a different percentage of your portfolio. It's now even more. So now what's the point of paying higher fees for something that's in trouble and a quarter cash?
So we're definitely coming back to the asset marking policies, because that's a huge detail of all these things. Can you also walk us through private credit, private real estate, private equity in terms of like evergreen fund structures, just at a high level too?
Yeah, they're all different. I'll try and focus on what's similar to them. Loans are the easiest. So private credit loans, they tend to be 3 to 5 years in duration, sometimes a lot shorter than that, rarely longer. And a loan is, you're getting paid interest every quarter. The loan's not in trouble. Most of them aren't. You know what par is. All right, that's pretty easy. If you have to write loans down because of defaults, then the manager needs to have a process to do that, because they are smaller companies and therefore riskier, or they're riskier in general. And I mean, if a company was big enough to go to the bond market, they just go to the bond market. They can't do that for some reason. Real estate, the evergreen real estate funds at least have an appraisal once a year, and they try to not do it at the same time, so that you get a rolling view of what the portfolio is actually worth. By definition, it's going to have a lag to it, especially lately with not much transaction activity going on in private real estate. Some are a little bit more proactive. I tend to like those a little bit more, where you're at least either doing a summary appraisal once a quarter, or if there's a material change to a property, I expect a new appraisal. So it's slow to move. That's why you don't see big returns plus or minus out of evergreen real estate funds, because you're not marking the whole portfolio every month. And the private equity is the biggest wild card of them all, because it depends what kind of private equity you're dealing with. And if you're investing alongside, if you're in a fund, like a secondary fund, you're at the whim of the manager that's running that fund and their valuation policy. You're just marking whatever somebody else thinks it's worth. If you're investing in direct companies, then you better have your own valuation policy, and we can agree with that. So that's even slower to move sometimes, because it's all over the place in terms of how they work.
This is something you'll see like as a criticism of these private assets all the time on Twitter, which is this idea, in 2020, basically, our public equity portfolio is a pure bloodbath. We're down 35% in a month or something like that. And they show like the private equity guy just sitting there, like relaxing with a drink, like, nothing's changed in the value of my portfolio. It's exactly the same. By the time they get to mark the thing, the whole thing's over. You see that a lot. And I wonder, I guess it's a two-sided thing to some degree, because all of us have this tendency, and we're seeing our stuff blowing up in front of us, to make poor decisions, so to some degree, it's probably good that I'm not seeing it marked down, but also like a lot of the times you're probably not seeing the true value of these assets, or at least you're not seeing it for a delayed period of time.
Right. We saw this especially in real estate in 2022. REITs were down, the publicly traded REITs were down 25 to 30% on average. Public REITs were positive. They both own real estate. Why would you want to buy something that's way up when you can buy something that's way down when they both own the same asset class? Well, in 2023, it reversed. REITs were positive thanks to the last 2 months of the year, and private REITs were flat to negative. They are meant to be long-term investments you hold for a very long period of time, if not forever. So you shouldn't worry as much about how, the month-to-month or day-to-day performance, but it's our nature to do that. And that's what concerns me the most about evergreen private equity that I'm still wrapping my head around. We've seen private credit go through 2020 and do just fine. In real estate, we had Blackstone REIT, which is the largest private REIT, so not an interval fund, we'll get to that, had more redemptions than its policy for more than a year and made it through it just fine. They followed what exactly they were supposed to do. I give them lots of credit for that. Private equity in an evergreen structure is still very new. There's only a couple funds that have been around for 5 years. They haven't seen 2008. They haven't seen the tech bubble. They haven't seen anything that is going to make investors want to sell, even when they shouldn't. Most people, as Warren Buffett would say, are the others that are. So these, regardless of what kind of structure you're dealing with, evergreen private funds are going to be the most liquid when you least desire it, because everything's doing well. And they're going to be the least liquid when your knee-jerk reaction is to sell. And that's not going to change.
Highlight that point with, 6 different colors of highlighter, because that's the biggest piece. When you're dealing with higher net worth individuals or people with lots of assets, and they can buy time horizon because they don't need liquidity, then they can weather these storms, theoretically at least. They can weather these storms that much more. Right. They can hold private assets and suffer through it because they've got other assets or other time to do it. the more these strategies and things come downstream and people under that $5 million liquid QP threshold have access to stuff like this, the more those investors need to understand, if I take this on, I got to know those liquidity risks that come with it, because market to market, all this stuff it's a whole different beast. It's a whole different knowledge gap that you have to get around your head.
Yep. And if we're investing client money for the next 20 to 40 years, there's no need for the entire portfolio to be 100% daily liquid if there are better opportunities that should offer higher expected returns than the public markets, lower volatility than the public markets, or both. But we still have to educate clients in ways like this and just individual conversations that you and I have, Matt, all the time. This is what we're dealing with. We think it should add value over the long term. You just have to treat it a little bit differently.
That's an interesting question, Matt, to ask you about planning, because that was one of the points Larry Swedroe made, which is he has obviously a huge amount, like 50, 60% of his portfolio in this. I don't think he expects your average person is going to do that, but he did say he thinks like your average person has way too little money in this, because when most people look at their financial plans, they don't need as much liquidity as they think they need, and they have the ability to put a bunch of money away for stuff like this. Like, how do you think about sizing something like this when you look at someone's portfolio?
We talked a lot about this in some of the earlier episodes. So on the financial planning side, the CCBS framework of you have to have the calendar, which is the ordering of dates, things we know are going to happen. We have to have the cash flows. So now what is the money coming in and out? What do the surpluses and deficits look like against all the stuff we know on the calendar? And then the balance sheet itself. What do we own? What do we owe? In the balance sheet, we take a bucketing approach, which is basically our short-term money, our medium-term money, and our long-term money. Once we understand how to bucket that out, only then, if we have sufficient short and usually medium-term money, do we start to think about how much liquidity do we actually need versus can we entertain an interval fund first? And if we can entertain an interval fund, should we look at an evergreen structure for something? And if we can entertain that, and usually this marches up with bigger balance sheets, can we look at like a drawdown fund or something entirely private in nature to think about on the balance sheet? You could only do that if you've gone through that whole exercise of understanding the cash flow needs against your balance sheet, how that balance sheet is built, asset allocation and asset location, so that you understand what you might need to draw from, when and why, and then run it through some kind of dire scenarios. Like, you got to beat the crap out of stuff and go, if I'm okay not to care, and Lee, comment on this for a second. If I'm okay not to care, what does it mean to come out of the other side of 2008 and 9 owning some of this stuff, or come out on the other side of COVID owning some of this type of stuff?
Yep. If you invested in private, granted it was only institutional at that time. If you invested in private equity in 2009, you did awesome. You were greedy when others were fearful, to quote Mr. Buffett again. That is one of the, we talk about behavioral finance a lot at some point, is one of the hidden benefits to evergreen assets. You are restricted from full liquidity when it might be a bad idea to sell in the first place. Now, is that always going to be true? Of course not. But focusing on the long term is an inherent feature of evergreen private assets.
If public markets are brutal in a downturn, private markets can be utterly savage. And I think this is a really important point. If your balance sheet can afford the utter savagery that is a drawdown, especially in public markets, but now spill it over into privates, it creates its own set of independent opportunities. And that's where, Jack, back to your point of like, how do you understand your liquidity and your balance sheet to do this? It's just a whole other opportunity set that it opens up the door to.
Going back to the structure part of this, if I sort of contrast like the other evergreen structures with interval funds, would the main difference be like, first of all, interval funds have a ticker, but then also these other evergreen structures can set their own policies in terms of they're not subject to that 5% per quarter rule, right? they can set their own policies in terms of how they want to handle that.
Yep. So there's two main differences. One is administrative. So like you said, there is no ticker for either a private REIT, so that would be for the real estate funds, or private BDC, which is another way to invest in private credit, or a tender offer fund, which is what you might see in private equity. There are three names for essentially the same thing. There's some level of paperwork. It's pretty short. It's not something terribly complicated. We can always help with that, but you probably don't need a lot of help anyway. The big institutional funds will have 60 to 100 page private placement memorandums and limited partnership agreements. You're talking here usually less than 10. And half of it is disclaimers at the end, so it's really like 5. And they can accept money at whatever pace they so choose, every month, every quarter. It's usually every month. And the second part is more important, and that's liquidity. So these funds must have some sort of policy that they plan to follow. So we'll take Blackstone REIT, for example, because I already referenced that one. Their policy is 2% of the fund's value every month for withdrawals and 5% per quarter. So if they went 1.5, they'd have 2 left for the third month. But if they went 2 and 2, then they only have 1 left for the third month. Whatever each fund's a little bit different. You could have 5%. A lot of times it's a little bit lower than that, but it's not guaranteed like the interval fund structure is. That's the biggest difference. There's some level of board of directors discretion to say, in a dire market, we don't think it's in the best interest of investors to sell this office building at 50 cents on the dollar. We don't want to do it. We're not going to offer liquidity. Again, they will be least liquid when you most want it. Those are the two big differences.
I'm wondering, like, that you referenced BREIT.
Yep.
That in a lot of ways, that was in the news a lot because I think
It
a lot of
was.
people were requesting money back. But in a lot of ways, that was sort of a positive experience with these fund structures, right? Because it did work as intended. There was no like collapse or something like that. Like, it did work as intended through that period where a lot of people were asking for their money back.
Right. Each fund's policy, and they got to stress test these things too, just like we stress test client portfolios. If a dire market situation happens and we get tons of redemption requests, how are we going to handle it? And with real estate, you do have some level of income coming in all the time from people paying rent, whether it's a person owning, an apartment, or office tenants or casinos or whatever it is. So that helps them in any scenario because you're always going to have income. But how do you handle that? I think they followed their policy that investors should have known, and most of them did know ahead of time, and they followed it perfectly. And it does seem a positive stress test for that structure in evergreen private real estate. Now, it is a pain because if you want all your money back, you usually have to keep asking for it over and over and over and over again. That can be a pain. With private equity, you generally see quarterly instead of monthly/quarterly. So it's a little bit more orderly in terms of how they would have to offer liquidity. Because again, they don't want to have to hold 25% of their fund in cash. I've seen 30% in cash. I'm like, why would you ever invest in this? That was a little bit of a historical example. I don't see 30% today, but it could happen. So when I'm diligencing these funds, that's something I'm really paying attention to. What is your plan? What is your policy? What is your plan? And what are you going to do about it in a left tail situation?
And it's interesting too, because like as an investor, certainly I want my money back if I want to, if I request my money. But the other side is I kind of like that idea of, not the interval funds, but the other structure where you have this board approval, because I don't know that I necessarily want them fire sailing everything to like meet redemption. So I kind of like the idea that check exists, that, they're not just going to fire sale the whole portfolio, at crazy prices to give people their money back.
Right. Which is why my personal bias is, I think that the REIT structure, whatever you want to call it, works fine in real estate, but credit works fine in interval funds. So in credit, most of the senior secured private credit funds have 10 to 12% yields right now. So they're getting 2.5% to 3% of their fund's value every quarter in income. It's not that big of a lift to make the other 2%. You might have to, loans mature all the time in a normal rate environment that get prepaid all the time. You have more liquidity. Whereas in real estate, I kind of like having that protection of against a forced fire sale.
It's interesting because these structures also, I think it's really important always when we're thinking about investment structures to almost think about them like they're just businesses. And when I hear you explaining it this way, I think about how as like a real estate entity or as a private credit entity, the structure of like helping shareholders or people or investors not be their own worst enemy is the thing that makes both the fund, the track record, and the structure work. Is that a fair thing to say?
It's a very fair thing to say. And again, some of the strategies and structures haven't been, fully tested yet in a down market, and I'm perfectly cognizant of that. But there's generally at least a plan that I can review, I can talk through. Hey, this happens again. COVID happens again. We don't want it, but what would you do? Walk me through it. And they better do that. And if not, we're never investing $1 with them.
So the Facebook Marketplace, I will just go to Facebook Marketplace and sell all the bank loans. That's not viable.
That's not what we're doing here. If you're looking to buy another lunchbox, you can go to. I don't see your Sunpoint lunchbox there, but
it's hiding off to the side.
If you want to start a lunchbox collection, that's a perfectly fine place to go. But and what helps all of the structures is their growth in the last 5 years. You have a lot more supply of buyers and sellers, especially in private credit, that even if you have to take a small haircut, if you have to get liquidity to meet demands of investors, you can do it. And with real estate, with the private REIT structure or tender offer fund, call it whatever you want, they work pretty much the same way. Those protections are built in to help that process not have to be overnight. There's usually notice period as well. That's usually not too onerous. Hey, our fund's liquidity is monthly and you got to give us a few days notice. Or our fund is quarterly and you got to give us a few more days notice. But again, those are all specified up front, and we're more than willing to help clients through that if they're interested.
What do the fees look like in these areas? Traditionally things like private equity, all these private things have reputations for having pretty high fees. Like when you get into the interval funds and the evergreen structures, like what do the fees typically look like?
Yep. So there's 2 points, Jack. One, private, whatever we're dealing with, their fees will be higher than a public counterpart. Period. So if you have an active fixed income fund at, say, 50 to 75 basis points, private credit's always going to be higher than that. Private equity is always going to be higher than the most expensive active equity fund. Any private REIT is going to be more expensive than any public REIT mutual fund, period. They are coming down. And even in what's kind of surprised me, especially in the last year, call it, is the Evergreen private funds sometimes have lower fees now than the institutional funds that might be doing the same thing, or they might be investing alongside each other. The industry, benchmark for years was 2% per year in management fee, plus 20% of profits over some hurdle rate. The investors have to earn a 5 or 7% yield, and then the fund's manager starts getting paid beyond that. With some of these structures, I've seen some at 1.25%, which is a lot lower than 2. I've seen some at 1.5%, and I know one private REIT that charges 75 basis points, which is about the same as some other actively managed public REIT funds. Now they're trying to make it up with a higher, carried interest or performance hurdle, call it whatever you want, to do the same thing. So if we as investors do well, the manager will earn a portion of that. But if they don't do well, then they don't. That's where they're trying to make their money is, hey, we're a private real estate fund. We think our fund will earn 9 to 11% per year on average. So we're going to charge a carried interest over 5. Okay. So you're going to, they better hit what they're supposed to, and then they'll take more of it. There's really very few evergreen private funds charging 2% management fee. And the ones that are generally in venture capital or growth equity, where fees are higher by definition because their private fund fees are also higher, and it takes a lot of work to run these things.
And a lot of them are going to get zeroed.
Tons of them are going to get zeroed.
Yeah. You're buying office buildings. You're hoping for very, very few zeros. If you're doing venture capital, you're expecting.
If you're a venture capital fund and you invest in 20 deals, 15 of them might return 0. Hopefully the other 5, and that'd be a great outcome, 5 out of 20. The other 5 hopefully return 5 to 15 times your money or more. If you're investing in real estate, you're not counting on zeros. That's not part of how this works.
You mentioned ventures. Is venture done any of this yet? Like, have you seen these evergreen structures in venture?
Very, very few.
Okay.
It just doesn't fit because the cash flows are so lumpy. You might invest in a great company that returns 10x your money over 5 years, but you get it all at the end. There's some that are trying to merge venture with more traditional private equity in some sort of blend, so you get some liquidity to try and meet investors' liquidity on a quarterly basis. All tender offer funds, and generally they're going to offer the lowest level of quarterly liquidity. It's the hardest, but there are at least a couple that are trying to do it.
How about a capacity? Like, will you see these things close? Like, if too many assets come in and they don't think they can deploy them profitably, will you see these funds like close?
It's a great question because it depends. You have to read the funds documents and what they're going to do with them. It is up to the structure and the manager. So there are some that I would expect someday to close. Like a mutual fund can close to new investors. The same with an interval fund can close to new investors. One of the negatives with BREIT is they were just taking cash in droves in 2021, 2022, and had to put it somewhere. They couldn't turn off the spigot, to my understanding. I haven't dug too deep into it, but that's what I've heard. So I don't think many of these funds are old enough yet to have run into that problem. But ask me a year or two from now, and might be a great question.
So my devil's advocate question I always like to ask about this is, when you think about private investments, there's always the idea that, the top endowments, the top institutions get the best private managers. Then you kind of work down to the next tier of institutions, they get the next best managers. And, one can make an argument that by the time it comes down to advisors and your average investor, like I'm not getting great managers. I mean, do you think there's anything to that?
Yes. It so what's the newer trend, Jack? In a few different cases, I'll give you like like there's a private equity fund I know of that has a few different managers that they're working with to get deals, and they're co-investing. The Evergreen funds co-invest alongside the institutional funds that the big guys get. So it's the same deal flow in a different structure. There's another one I just saw not too long ago that they've identified 4 of their private funds, the same funds that your endowments and institutions get. And their new Evergreen fund will get a piece, to the extent that they can handle it, of all the deals in those funds. So that's how they're mitigating it through investing alongside the funds. The Evergreen fund has the added requirements of liquidity and has to hold cash and other liquid assets to handle that. The private funds obviously don't. So it's a little bit of an operational hurdle for the manager, but if they want to make Evergreen private equity work or private assets work, and to answer your very valid question, that's how they're doing it, is investing alongside big guys in a different structure.
And with interval funds, are they mostly operating like through financial advisors rather than your average person being able to go in and buy the interval fund? Is that the way it typically works?
Most of the time, yes. Well, an average retail investor who with no advisor probably isn't going to know they exist in the first place. Even if they stumble across them, they might see a minimum investment on their custodian that's far too high for them and get scared off anyway. We can, and plenty of other RIAs can get in at the firm level. So we have one interval fund we work with that has a stated minimum of $10 million. Right, how many retail investors can meet that? 0.
Speak for yourself, Lee. Speak for yourself.
But since we've long since met that minimum, we can get any new client in at whatever they want to put in.
Speak for me, Lee. Speak for me.
$1.
Yeah.
To buy the car, Bob. So that's and I've seen some other interval funds that have minimums posted on custodial sites. They're not terribly enforcing them very strictly. Some are, some aren't, but it's there's only a handful of interval funds that have really high minimums. But again, most retail investors have never heard of these things and aren't gonna know what to do with them. They'll probably just find something else.
And I would think that's a feature, not a bug, to some degree, because
It's
your
very much
average
so.
person just buying this and has to understand all these rules about when they get their money back. And, you're
Right.
probably better off working through somebody who knows how these things work rather than doing that and then
Absolutely.
trying to sell it and being like, oh, I
Right.
can't sell it. I can't get my money
Yeah.
back. Like I want it now. Like, I think probably for now, these are probably better done through advisors.
Right. And one thing I didn't mention about interval funds is that they are required to tell you when their date is and that you have an offer to sell. It's a 1 or 2 page letter in very professional looking lawyer written stuff. So if you're not a savvy investor or don't have an advisor and you happen to stumble across one of these things, you get this letter and you be like, well, do I have to sell? No, you don't, but you can on this day. And different custodians work a little bit differently. Some make you put in your order on that day. Some will take it like a week early. But if you get this letter in the mail and you're like, it says corporate action, well, what does that mean? I don't know. And you would have no one to talk to.
I'm just curious as we wrap up here, what do you see as the future of these? I mean, if we look 5 to 10 years out, I mean, will these be a bigger part? Will more people be using these? Will these be a bigger part of people's portfolios? Like, what do you see as the future for these going forward?
If people like Matt and I do our job well, I think there's no doubt that Evergreen private assets will be a much larger part of an average client portfolio. They're also getting used by institutions, which is the interesting part. So let's say you're a huge hospital foundation and you have $1 billion and you have a target that you want to hit to private equity, right? But that's an impossible target to hit because you're always having capital calls, you're always having distributions, your funds are making money, hopefully not losing money. It's a hard target to hit. So what some of them are now doing is using a part of their slug, their private equity allocation in this case, and putting it in an evergreen fund. So if they're too far below target, they can top up any month they want or any quarter. And if they're over target, they have a place where they know they can at least get some liquidity. So that's even giving more credence to this evergreen structure and then letting clients of ours follow along, which has been really interesting. And it makes a lot of sense for them. I worked with plenty of them. It makes a lot of sense.
So I think a lot of this in terms of, this is my pop culture reference for the day. I think a lot of this in terms of the Howard Stern book and movie Private Parts. And with private markets, there's so many things that are more interesting than the public stuff. And in that true Howard Stern sense, like the stuff you technically can say on the radio and the stuff somebody might be willing to say on the radio back in those days of like pushing the envelope and the shock jock thing. And this is the reality of it though. As it gets more popular, more of the private stuff comes into the public eye, and there's a sweet spot where it's fun and exciting and interesting. But then there's also a part down the road where it ends up being serious, and it ends up meaning Sirius XM and whatever. Like it ends up there and it's not quite the same as it was when it was emergent and shocking and interesting. We're probably the democratization, the productization, whatever you want to call it, this stuff becoming accessible is kind of in that sweet spot. This is Howard Stern at WCCC in Hartford, like pushing that envelope out in the early days. We're here right now. As investors, as allocators, we're looking for those opportunities and where some interesting stuff can happen, but it's not going to be this way forever. And you got to understand the different access points because it's really easy to screw this up. Jack, to your point, it's easy to screw up the financial planning around this stuff. Lee, to all your points, it's easy to pick the wrong vehicle or not understand the corporate action that says you can only have so much money out. Or I think about this with knowing some people with the B-REIT experience where it's like on those gap years where public markets are in the toilet, but Jack, to your point, like the B-REIT is, I have my drink. Look at I didn't mark any of my assets down yet. This is the kind of stuff that happens. It creates opportunities. It's easy to get burned, but if you understand it, this coming downstream represents a bunch of huge opportunities for people who didn't have access before.
Matt, I'm happy you got the pop culture references because, as you know, we cannot end the podcast any week without some sort of pop culture reference.
I feel morally obligated, and I'm really excited because I actually didn't think of the Howard Stern Private Parts reference until like halfway through, and I was like, oh, this totally makes sense. This is Robin getting fired. This is Allison's miscarriage. Need to go back and rewatch this now.
You also saved Lee because I could have peppered him with questions for about 4 hours on this. So waiting for you to come in with the pop culture reference. So he should be happy as well that you did that.
Lee, I'll be peppering you with both later today. Don't worry.
All right, I'll be ready.
Well, thank you, Lee, for joining us. Matt and I certainly could not have done this on our own, and it would not have been very informative. So we really appreciate you doing it.
I always love to talk about this stuff.
And thanks everyone for joining us, and we'll see you next week.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.